It's a new month with new records. So now what happens? Let's get some answer from Michael Ryan. He's Chief Investment Strategist and Head of Wealth Management Research at UBS. Mike, nice to have you. I mean, this has been a phenomenal year for the stock market. Are we seeing the second leg of the bull market? I mean, what is your outlook?
I do. I actually think that stocks can continue to go higher, but I think we have to temper our enthusiasm a little bit because I actually think the second part of this is going to be very different than the first. You kind of had this re-rating of stocks that was driven largely by an absence of malice. We didn't have a lot of bad news. A lot of things weren't melting down or blowing up. I think in the second half, though, what we're going to have to continually see is better revenue growth, better corporate earnings, and an improving macro backdrop. I heard Bob Pisani talking about this expectations about better growth. We need to see that validated in the second half of the year in order to extend this rally.
Are you expecting that better growth to kick in, or what do you think?
Yeah, we are, Tyler. I think what you are going to see now is, and I think it was evidenced by some of the economic data this week, the ISM report was encouraging, not only in terms of the headline number, but also the components. If you look at the more forward-looking components, that's actually the most constructive part of the report. It suggests to us that the growth dynamic over the course of the next couple of months is going to be constructive. I would also argue, obviously, that tomorrow's employment report is going to be important in terms of setting the tone, because we need to see if we're starting to see this business improvement picking up in terms of hiring.
All right, let's talk a little bit more about that jobs report. I mean, talk us through that. If the number comes in on the high end, or if it comes in on a lower end, what impact is that going to have on the markets?
Well, first of all, we have to move away from this notion that, bad news is good news. I think actually, good news is good news, and that if we get an employment report that comes in at or above consensus expectations, I think that can help to extend the gains we've seen in the equity market. So I think it's going to be really important in three facets. Number one, we have to see the rate of employment growth is still in that, that, let's say, 185 to 215 range. Secondly, we do have to see some improvement in terms of the unemployment rate coming down. And it has to be in an environment where we're not seeing people leaking out of the labor force. It's got to be one where the labor force remains fairly static.
A lot of the time, rising interest rates are anathema to rising stock prices. But do you think that equity investors have now gotten comfortable with the idea that rates are up and probably likely to continue to move higher? The 10-year was at 270 today.
I think it depends to a large extent on why rates are rising. If rates are rising because there's a fear that inflation is accelerating and that it may force a tightening of policy, then that's one thing. If rates are beginning to move higher because we're seeing a normalization in the business cycle, we're seeing improvement in macro conditions, I think that's actually very healthy for stocks. In fact, what we argue is that what we're entering now is sort of a sweet spot with regard to rates when you look at stocks. Because when rates are very, very low, it's a sign of distress. When rates are very, very high, it's a sign that price pressures are picking up and the Fed may have to tighten. So actually, we're sort of entering that period that should be pretty constructive for stocks.
Mike, let me go back to what you said at the very beginning, where you said investors shouldn't get carried away by today's rally and these new records. So should investors sell into these rallies, get into position and take the best that they've gotten so far this year, take the profits now?
No, I wouldn't say you want to sell into this, but I do think you need to continue to reposition during this market. For example, what had worked earlier in the year is not likely to work through the balance this year. There had been this gravitation towards the higher yielding sectors and more defensive sectors. We continue to see a rotation now throughout the balance this year away from those sectors that performed really well in the early part of the year and into the more cyclical sectors, because we think that's where you get better opportunity for earnings growth and where we still think valuation is more attractive.
All right, sounds good. Thank you so much.
Thanks,
Michael Ryan of UBS.